Okay, good.
Yes, and we're good to go. So I'll start us off. Uh, I see the participants are still increasing. So now it's steadily heading towards 200. Now, good evening, everyone. And this is a special occasion, isn't it? It's a special night. I can see a few really happy faces. And why not? It's not often that you get to come face to face, albeit virtually, with one of the biggest intellectual legends, one of the finest intellectual luminaries in the world. All the finance students, all the CFAs, and all of the MBA candidates and alumni can truly appreciate the magnitude of the fact that we have in our midst Professor Aswath Damodaran. Now, the NYU Stern website will tell us that Professor Damodaran is the Kirshner Family Chair in Finance Education and a professor of finance at New York University, Stern School of Business. It'll also tell us that he was voted Professor of the Year by the graduating MBA class 5 times. But it won't tell you that Professor Damodaran is the first and last resort
हो गया
candidate.
बट आवाज क्यों नहीं आ रही?
It won't tell you that Professor Damodaran is the first and last resort for the MBA candidate struggling to understand finance, unable to comprehend the sharp array of acronyms and complicated tables. Fortunately or unfortunately, I count myself among those struggling students, resorting over and over to Professor Damodaran's books and videos and online lectures, being handheld through the most intricate of problems. Professor Damodaran's books on corporate finance and valuation are the two true Bibles an MBA student invariably has. Now, before we proceed, I'd like to invite Professor Kanagraj, the placement chair for the XLRI PGDM GM program, and our very own fount of finance knowledge, to welcome Professor Damodaran.
Good evening and welcome you all for this wonderful session. And it's a great privilege to hear one of the outstanding business valuation professor in this world. And I've been teaching this subject for some time, and we keep referring to you again and again. And we have been using all that resources what you have created. And you are a great inspiration. And your video is the one of the video what is watched all over the world by business school students, especially finance students. And they bring a lot of learning from your videos, your resources to the class, and they question me on that. And I try to manage with all those answers, and may not be the way how you can really manage. And it's really so honored to be part of this session. And each one of the student who are specializing in finance are looking forward for your session. And it's a privilege you accepted our request, and you have given your valuable time to talk to us and discuss with us. And it is going to be a memorable event for us. We welcome you again for delivering the speech. Thank you so much, and we look forward for your insightful pointers on valuation. Thank you.
Should I take over, Ayush?
Yes, sir. Over to you.
Okay, let me share my screen because I need that prop to keep going. I'm setting up. I mean, this is something it's become part of my life. For the last year, I've been teaching out of this room in my house. And I don't think I've moved more than 4 blocks away from here. So I'm becoming very used to talking to my computer, which is not a healthy thing to do. Now, I thank you very much for the introduction. I don't know whether I can live up to intellectual, luminary, legend, etc. I'm a teacher. No, that's basically how I've always described myself. I'm not a professor. I'm not an academic. I'm not a researcher. I dabble in valuation. That's what I would use. I dabble. I dabble in whatever interests me that week. And guess what? I have a very low threshold for losing interest. So basically every week I move on to something different. So this week it could be Airbnb, and next week it could be Aramco, and the week after that could be the Fed. So the reality is nothing I do is in depth enough to be considered intellectual reasoning or research, but it is what it is. I prefer to think of myself as the Kim Kardashian of valuation. So I have celebrity status, but I don't know what that actually means in a world of social media and YouTube. So what I thought I would do is compress everything I know about valuation into about 45 to 50 minutes. You know what the scary thing is? The more I learn about valuation, the less time it takes me to compress everything I know and deliver it. When I first started teaching valuation, I said, you need to give me 3 days and 26 hours to talk about valuation. Now, if you give me 45 minutes, I'm pretty much done. Everything after that is icing on the cake. So let me start with a little bit of introduction. I came to NYU in 1986. And when I came to NYU, I was hired as an assistant professor. I was given a class to teach. It was a class called Security Analysis. You guys heard of this class? It's a class with a very long and hoary tradition. It was a class that was taught in the 1980s at 1950s at Columbia University by a guy called Ben Graham. You heard of Ben Graham? Even if you haven't heard of Ben Graham, you probably heard of his most famous student. Anybody want to pipe in and tell me who that was? Or who that is?
Warren Buffett.
Warren Buffett, right? So it's a legendary class. It's a class that's been taught a long time. So the head of my department gives me this class and he says, this is security analysis. I'd like you to teach it. I take one look at the class and said, I'm not teaching this class. The most boring class ever. Because by 1986, it was showing its age. It was 4 weeks on stocks and 3 weeks on bonds and 2 weeks on futures and options and 5 weeks on institutional detail. There was an entire session on listing requirements for the New York Stock Exchange. You know what? Teaching was so easy in the days before Wikipedia. You could go into class and list out the 12 listing requirements of New York Stock Exchange. Everybody took everything down and they walked out of the class saying, that guy's a genius. He knows all 12 listing requirements. If I tried that today, people would be checking Wikipedia while I do it, say, I can see it right here. Why do you keep telling me this? So I went to the head of my department and said, look, I don't want to teach this class. It's too boring. He should have just fired me on the spot. I'm an assistant professor. I've just been hired. I'm refusing to teach the class. But he was a good guy. He said, what would you like to teach instead? I said, I'd like to teach a valuation class. He said, don't do it. There isn't enough stuff in valuation to fill a class. And you know what? In 1986, he was absolutely right. There wasn't enough stuff in valuation to fill a class. There were no books on valuation other than Security Analysis, which was written in 1934. There were no materials in valuation. Nobody taught valuation as a class. When I did my MBA, I tell people, look, I got 30 minutes on valuation in a 2-year MBA program. And what I got was a Gordon growth model, which is expected dividends next year, cost of equity growth rate. Now go out and value companies. It's cruel and unusual punishment to turn people loose with the Gordon growth model and ask them to value companies. I think of the analogy I offer is like you use the Gordon growth model to value companies. It's like using a hammer to do surgery. It's going to be bloody. It's not going to end well. But it's a very, very rough tool. But I really, really wanted to teach this class. And I discovered very early in my academic life that if you want to get anything done at a university, the best way to do it is to do it subversively. Because if you try to get official permission, you know what would happen? A committee would be formed. You guys have experiences with committees being formed? You know what happens after a committee is formed? It meets and it meets and forget what it's meeting about. It continues to meet. Then there's baby committees that it calls subcommittees, and the subcommittees of baby subcommittees. Take about 40 years later, they'd come back to me and say, you can teach the class. And I would be too old to teach it. So I said, okay, I'll teach you security analysis class. And I walked into the classroom, closed the door, and taught a valuation class. They have no idea what I do in a classroom. Especially in 1986, there were no cameras in the classroom. I could be teaching cooking for 15 weeks, and as long as everybody got A's, nobody complained. You know how long it took them to catch on? In 2008, I get a call from the dean's office. So we hear you're teaching valuation. Yeah, I've been doing it for 22 years. They said, we don't see valuation listed anywhere in the NYU course listings. I said, that's easy to explain. It's because I've been hijacking all these other classes you've been giving me that I'm not in the least bit interested in teaching and teaching valuation instead. They said, that's not right. We should call it valuation. I said, I agree. So if you look at the NYU course listing, you'll see valuation show up for the first time in the fall of 2008. This semester, I'm teaching 2 valuation sections, 1 to 350 MBAs and 1 to 350 undergraduates. And incidentally, I teach exactly the same class to both. This will be my 58th and 59th semester teaching valuation. I'm going to say something about this class that's going to encapsulate everything you're going to hear from me for the next 40 or 45 minutes and the way I think about valuation. Everything I know about valuation, I've learned in the course of teaching this class. Notice how I phrased that. The first time I taught valuation in 86, I had no idea what I was doing. My syllabus, I remember, ran 4 weeks for a 15-week semester. And students came up and said, how come your syllabus was only 4 weeks? I said, that's all I've thought of so right now. They said, what happens after week 4? I said, we'll find out, right? Thank God I came up with stuff to keep filling the rest of the semester. But everything I've learned about valuation, I've learned in the course of teaching this class. And I'll give you a few examples. A year into my teaching life, it was the fall of 1987. It was October 19th of 1987. I'd finished teaching my valuation class. I come back to my office. At that time, NYU's business school used to be downtown, right next to the American Stock Exchange. I looked out of my window. I was on the 9th floor. I looked out of my window. And I noticed that everybody on the American Exchange trading floor was out on the street. I said, what happened? A fire alarm went off? You know what happened on October 19th of 1987? Anybody? The S&P 500 dropped 22% in one day. 22%. Think about the equivalent today. If the Dow dropped by 22% today, that would be a 7,000 point drop. The Sensex dropped 22% today. Think of how big that drop would be. It was a one-day bear market. It was a shock. Nobody had ever seen anything like this before. 2 days later, I was back in front of my class. Guess what the first question was? How do you explain a 22% drop in the market in one day? You know what? You can't evade the question. Valuation is full of questions about what's going on in the real world, and you can't talk in abstractions. So we had to talk, and they might not have been happy with my explanation. We had to talk through why a market might drop by 22% in one day. Flash forward a 10-year period, late 90s. What's happening? It's a dot-com boom. We're surrounded by companies with very little revenues, big losses, and lots of potential disrupting the world. You know what the question I kept getting asked was, how do you value a company like Amazon when it has and this was when Amazon was an online book retailer with very little revenues. How do you value a company with small revenues, big losses, and lots of potential? I tell people that everything I know about valuation of young companies, I learned in the process of valuing Amazon in 1997. It was a traumatic experience. I kept a journal of every roadblock I ran into because nothing in the books would have helped me because there was nothing written about how to value companies. I had to make up the script as I went along. I kept a journal. The journal got to be 75 pages. I never waste anything I write. So I slapped a title on the journal, The Dark Side of Valuation, Can Amazon.com Be Valued? And that paper, of course, became a book 3 years later. But I learned about valuing young companies because I had no choice. I was in a classroom and people needed the tools to value young companies. Move forward another 10 years. It's 2008. You're in the midst of a meltdown. It was September 12th. It was the start of my fall semester. The meltdown happened in real time while I was teaching this class. And the big question people had was, what the heck is going on? And at the center of the meltdown were banks. And people were wondering, why, if banks are in trouble, should the rest of the world go down with them? And we had to talk about side costs of companies going down, that it's not just the stockholders of the company, but at the bank, you essentially drag the rest of the market down. We had to talk about interconnections across companies and how risk-taking at one company can become risk-taking at all companies. And then you get to the last decade and you saw the rise of social media. Companies whose most impressive number was not in their financial statements. When I say Facebook, what's the most impressive? What's the number on Facebook that is mind-boggling? Anybody want to try? What's the most mind-boggling number about Facebook?
Users.
The users.
Number of users. Its revenues are not that impressive. There are companies with 5 times its revenues. Its margins are high, but there are other companies with high margins. But it's got 2.5 billion users. Think about that. 1 in every 2 adults on the face of the earth is on Facebook. When you look at a company like Netflix and you say, what's the most impressive number? It's the number of subscribers. Could we have visualized a company with 300 million subscribers or 250 million subscribers? So you know what the key question that I kept running into over and over the last decade was? When you have a company that derives its value and pushes the notion of users, subscribers, members, how do you value a user or a subscriber or a member? Valuation traditionally is top down, right? You take the revenues of the whole company, you take the expenses, you come up with income. We'd never really grappled with the question of valuing a user. But I couldn't avoid it because we were running into this issue over and over again. Was Facebook, then LinkedIn, then, and in fact, finally in 2017, I gave in and said, you know what? I'm going to try to value an Uber rider. Because here's a company that says, let's 50 million riders. I mean, let's face it, all is the most impressive number. It's not its operating income because it manages to lose money no matter what. But the number of users, riders, subscribers. And last year, you know what the big question was. We're in the middle of COVID. How will this play out when you value a Boeing, an airline, or a Zoom? Remember, COVID cuts both ways. Some companies benefited, some companies lost. What I'm trying to say is valuation is not about theory. There is, in fact, very little theory here. It's all about dealing with what's going on around you. That's why I find valuation fascinating. It can never be boring. People saying, is this an interesting time? It's always been an interesting time for me because there's always something going on that you cannot explain. I'm going to start off actually with something that is going to sound like a waste of time to you because you might be in a hurry to get to betas and risk-free rates and risk premiums. Trust me, I'm not going to talk about them. This is not the forum to spend 40 minutes talking about equity risk premiums. You can watch me over and over. I've got multiple videos on it, multiple classes on it. This is when you're talking for 45 minutes, you've got to lay what I call the broad philosophical foundations. In fact, what I'm going to say over the next 10 minutes is probably more critical than anything I could talk about in terms of specifics and valuation. I'm going to lay the themes that drive how I think about valuation. Let's start with the first one. One of the questions I'm constantly asked is valuation an art or a science? Let's break that down. Is valuation a science? Let's make it simpler. Is mathematics a science? What do you think, Swaroop? Is mathematics a science? Unmute yourself if you can. If you can't unmute yourself, obviously I can't call on you.
No, maths is not a science.
It's not a science. It's not a science? Is that what you said? In fact, mathematicians are, it is the only pure science. In fact, mathematicians are convinced that mathematics is the only pure science. Everybody else is an imposter in their world. You know what makes mathematics a science? I hate to be insulting, but what's 2 plus 3? I can use my finger. 2, 3, 5. Right hand, left hand, North Pole, South Pole, calculator, computer. It's not maybe 5, it could be 5, it is 5. If you get any answer other than 5, you're wrong. You see the essence of a science? It's absolutes. You get the inputs right, you get the output right. If you get the output wrong, you must have done something wrong. So mathematics is clearly a science. Physics is mostly a science, right? You jump out of the 10th floor of your building. The speed at which you fall has nothing to do with your IQ or where you are in the corporate hierarchy. The laws of gravity are the laws of gravity. But if the essence of a science is that you get the inputs right, you're going to get the output right. Is there any chance of valuation ever being a science? Let's get this out of the way. Zero. None. And let me explain. I mean, last November, I valued Airbnb at the time of its IPO, just as of every big name IPO for the last decade. I jump in right after the prospectus and I try to put a number. And I'll talk about why I do it right after the filing of the prospectus. And I did my best. I collected the data of the company and no, excuse me. I collected the data of the company. I did my homework. I did everything the way I was supposed to. I used every tool in my arsenal and I came up with the value. But does it mean I get the value right? I got every single input right as far as I could tell. But the one thing I can guarantee you is there's 100% likelihood that I'm wrong. Why? Because I'm trying to forecast the future. You're not God. You sit down to value a company, of course you're going to be wrong. You know how much damage is done to valuation by people trying to make it a science? What do? They write rules. This is why accountants should not be allowed to do valuation. If many of your accountants don't take it personally or take it personally, I really don't care. Accountants should not be allowed anywhere near valuations because they think the answer to any valuation problem is let's write more rules. They're trying to make it a science. Didn't the Indian government pass a rule sometime over the last few years where to be an appraiser in India, you now have to go through a certification program and pass some exams? Good luck with that. If you think this is somehow going to make valuations better and more precise, you're barking up the wrong tree. Valuation is definitely not a science. So it must be an art, right? Let's take that apart as well. Is painting an art? I'm not talking about painting your house. I'm talking about the paintings that hang in the museums. All right.
Yes.
I remember taking my son, when he was 8 years old, he's now 30, so it's a long time ago, to a Picasso exhibit at the Met. So we go to the exhibit. 30 minutes later, we're out because that's how long an 8-year-old lasts in a museum. And I turned to him and said, Ryan, what do you think of that exhibit? He said, Dad, I was not impressed. I said, what? That's a Picasso exhibit. He said, this guy can't get the nose in the right place. Have you noticed about Picasso's? The nose comes out of the side of the head, the top of the head. It's almost like he was either drugged or drunk, which given Picasso's history is probably both. But for whatever reason, we've decided that Picasso is special. You see where I'm going? When you look at art and you say, this artist is amazing, it is based entirely on perception. And let's face it, great artists are not taught. They're born with a special skill. You cannot teach art beyond the basics. There are people, in fact, who can teach you how to do impressionist painting, just like Picasso. But trust me, nobody's paying $200 million for your impressionist painting, no matter how well you've been taught. Thank God valuation is not an art, or I wasted 35 years of my life trying to teach something that cannot be taught. So if it's not a science and it's not an art, what the heck is it? I'll give you the word that I used to describe valuation. It's a craft. In fact, the discipline that I think comes closest to valuation is cooking. Think of how you learn cooking. You could watch cooking shows on TV, you could read cookbooks, but trust me, if all you do is watch shows and read cookbooks, you can't cook. To learn cooking, what do you have to do? You have to go into that room in your apartment or house called the kitchen. You've been avoiding it for a year now because you've been ordering out every night. And you have to start cooking, right? And the first time you cook, what happens? fire alarms go off. Disaster strikes because you had no idea what you were doing, but you learn cooking by cooking. You learn valuation by doing. I'm going to give you some advice. Stop reading so much. Stop watching other people talk about valuation so much. Start doing your own valuations. You know, have you seen Hamilton, the play? It's one of the more famous lines in it is talk less, smile more. It's a very, so if you listen to the song, in valuation, I'm going to steal that phrase and say, read less, do more. If it's a craft, you learn better by doing valuation. The more different companies you value, the more you can get better. If all you do is value steel company after steel company after steel company, that's like scrambling eggs day after day. You're going to get really good at scrambling eggs. But then if I give you pasta, you say, I don't know what to do. So value steel company this week, a technology company the week after, value Ola the week after, value Rush. And one of the problems I think in India is because you think that all you have to do is the domestic market, you keep valuing Indian company after Indian company after Indian company, and you say, hey, that's all I'm going to be doing. Why should I ever value a Ukrainian mining company? Guess what? Valuing that Ukrainian mining company will make you better at valuing an Indian mining company. In fact, one of the most constant, at least every week, I get at least 30 or 40 emails saying, why don't you value more Indian companies? I said, what difference does it make where a company is? A company is a company. You care about cash flows, growth, and risk. But Indian companies are special. They must need some special. No, it's the same valuation model no matter where you are in the world. Are your estimation challenges different because you're in India? Of course, but you're not special. You think Brazilian investors don't face challenges very similar to Indian investors in the value companies? It's a craft, and the more you spread your craft, the better you're going to get at it. Second, I'm going to draw a contrast between two words that we use interchangeably that we need to stop doing. The words are value and price. Let me explain. We know what drives the value of an asset or a company. It's cash flows, growth, and risk. That's it. We've known forever that Venetian glassmaker in the 1400s, when he sold his business based on cash flows, growth, and risk, he might not have used beta as in the capital. But trust me, people have always thought about risk and the return you need to make to cover risk. We act like we invent these things, when in fact, all we've done is put structure on what people already do. So value is driven by cash flows, growth, and risk. A discounted cash flow valuation is just a vehicle. It's not a method. It's not a model. It's a way of thinking, right? Because in discounted cash flow valuation, what do? You project cash flows, you bring in the growth into the cash flows, you adjust for risk, and you say, this is the value. Hey, this is not a model. This is a way of thinking about how much you pay for a business. You base it on what the business is expected to do in the future. Say, what other choice do I have? You could price the business. Say, what's the difference? You know what price is driven by? Demand and supply. How do you decide how much to pay for something? You look at what other people are paying for similar things. Think of it, those of you who own a house or an apartment. Think about how you came about to own that house or apartment. A realtor showed you the house or apartment, then they named a price, right? Did they do a discounted cash flow valuation to come up with that price? I don't think so. They looked at other apartments in the neighborhood that had sold recently. That's pricing. You're saying those unsophisticated realtors. You pick up a sell-side equity research report. What's the basis for the buy or the sell recommendation? This stock is trading at 15 times earnings. Look, these other stocks are just like this stock. They trade at 20 times earnings. 15 is lower than 20. Therefore, this stock is cheap. I think actually the realtor is on more solid ground, claiming to have found an apartment just like yours than the equity research analyst is. Much of what passes for valuation out there, and I'm talking about equity research, M&A, is pricing. It is not valuation. 90% of the people who claim to work in valuation are doing nothing of the sort. They're working in pricing. Nothing wrong with it, but it's a very different perspective. You say, but don't the two have to be the same? If you are a firm believer in efficient markets, you might argue that the two are the same, but the very fact that you're working at a portfolio management firm, you're doing an acquisition, You're investing in a company tells me what? That you think that the price and the value can be different numbers and you're trying to take advantage of that difference. The third thing, and this is something that it took me a few years to get to. One of the questions I start my valuation classes off with is I walk in the 350 MBAs in a typical year. It's a physical classroom. I teach in an amphitheater and ask a question. What comes more easily to you, working with numbers or telling stories? In fact, let me throw that question. Think about what comes more easily to you, working with numbers or telling stories?
Telling stories.
There's no right answer, right? So basically it reflects my guess is most of you knew when you were 7, 8, 9 years old what you like to do more, right? Whether you like to do the math class or whether you wanted to go sit in the reading class, whether you wanted to take history or whether you wanted to do algebra. And then, I'll tell you when I knew when I was 12 years old, and it was after an English class, and I was asked to read Moby Dick. And I did. And I came in expecting the class to be all about whales and captains. And nobody was talking about the whale. So I remember putting up my hand and said, when are we going to talk about the whale? And the instructor said, there is no whale. And I said, what, did I read the wrong book? I distinctly remember a big fish all the way through. I still remember what she said. She said it was a metaphor. My jaw dropped. And the rest of the class was about hidden meanings in the book that I didn't even know had a meaning in the first place. You know what my reaction was after I took that class? I came out and said, never again am I going to subject myself to that kind of bullshit. And the rest of my high school life, I avoided these soft classes in every class, numbers degree. And for most of you, a numbers job, right? I remember my first, I was part of the 1977 incoming IIM Bangalore batch. I think there were 99 students in that batch. I think 96 were recovering engineers. People either out of an IIT or and you know how engineers think, right? You've spent your entire life you are a numbers person. It's been drummed into you that numbers are the answer to everything. There are people who are story people, who like hidden meanings, who love telling stories. And guess who thinks they have the advantage in a valuation class? When you think valuation, what comes to you, numbers or stories? In today's day and age, you know what comes to mind? An Excel spreadsheet. That's basically what valuation has become, a big Excel spreadsheet. And that's a tragedy of monumental proportions. We've lost control of valuations because valuation has become modeling. You become an Excel ninja, right? That's basically what every valuation is, become an Excel ninja. You go to work in investment banking, it's all about being an Excel ninja. An investment banker could not value a $20 bill in a brown paper bag if you put in front of him or her. But they can churn out 500 line item Excel spreadsheet that look really impressive. So I'm going to let you in what I think is the biggest hidden secret in valuation. A good valuation is a bridge between stories and numbers. See, what are you talking about? When I show you my valuation of a company and I show you my revenues in year 10 and say my revenues are 10 billion in year 10, and you ask me, how did you get to 10 billion in year 10? Here's the answer you should hear from me. It's because I used a 30% growth rate for the first 5 years and 20% thereafter. That tells you absolutely nothing about the company. I need your story about this company, the business it's in, that explains the 10 billion. Every number in your valuation has to have a story attached to it. And every story you tell me about the company, about its great brand name, about its amazing managers, about its wonderful customers, has to show up in a number. But if you have only one half of this, you can never do valuation. If all you have are numbers on a spreadsheet, you don't have a valuation, you just have numbers on a spreadsheet. You have a financial model. If all you have is a big story about the company, a lot of founders and VCs tell big stories. You don't have a valuation. You just have a fairy tale. It's until you connect the two, you've really not valued a company. And you know what? There are people who work in valuation all of their lives and have never really valued a company. They've been mechanical. They know all the mechanical tricks on how to project things, but they've never really valued a company. Which brings me to my final theme. I don't value companies because I'm intellectually curious. I don't lie awake and say, I wonder what Facebook is worth right now. Maybe you do, but I don't. You know why we value companies? It's because we want to act, at least for me. I don't get paid to do valuation. I do teach valuation, but I do valuation because I want to act on those valuations. You know what I mean by act, right? Microsoft is trading at $250 per share. I value it at $300 per share. What does acting mean? What should I be willing to do? Be willing to buy it at $250, right? You're saying that's easy. Of course I'll do it. Try it out. You're going to see how difficult it is to go from a valuation to actually acting, especially if it's your own money. Because other people's money, you have no problems. You just put their money in. Who cares? It's their loss. But if it's your own money, you're going to have to pull the trigger. And to pull the trigger, you need faith. It always throws off my valuation class when I use the word faith, because this is not something you taught. They expected. You see, what faith? You see where faith comes in? To make that buy decision, what do you have to have faith in? Faith first, that your value is a reasonable estimate, that you've done everything you can. Not that it's perfect, but that you feel comfortable with the 300. You need faith in your own valuation, but you also need faith in something else. How do you make money? What has to happen? You buy it at Microsoft at $250. What has to happen, assuming you were right about value, for you to make money? The price has to move to the value, right? And the next time you decide to dump on efficient markets, be very careful. We all believe in efficient markets, the question of when, because if markets were completely random, you couldn't even if you believe there's a mistake, you couldn't act on that mistake. You know how difficult it is to get that faith? And it's even more difficult to hold on to that faith. This is why most portfolio managers fail. They have no faith. They have strategies. You know how they get the strategies? Looking at whatever worked last year. Or buying low PE stocks made a lot of money, therefore I'm going to buy low PE stocks. Buying tech companies made a lot of money. They chase the most successful strategy from the last year. But they have no core philosophy because they have no faith. This is why so many people can talk the value game, but they can't walk. Because it requires faith. And you know what? This is the one thing I cannot teach my students. I can show them how I came to my position of faith. I can be open about the fact that my faith gets shaken sometimes. You know what I mean by shaken? You go buy Microsoft at 250 because you think it's worth 300. The next day you wake up and the stock is down to 225. You know what the market is doing? It's knocking on your door saying, do you still have faith? You say, yes. Next day it drops to 210. It comes and knocks on your door again. Do you still have faith? You know what? For most people, that second day, the third day, the fifth day, for the fifth day, say at 177, no, I've lost faith. I'm going to sell and move on. And I'm open about it in my class. So when I make when I valued Airbnb, I valued it at about 40 billion. And now that it's at 120 billion, people say, do you still believe your valuation? And I look at my valuation, look at the fundamentals, and I say, you know what? There might be other people out there with a much bigger story. But my story for Airbnb and my numbers, I think it's worth 40 billion. And I've got to invest based on what I believe in. I mean, for some of you who read my blog, you do know that I bought Tesla in June of 2019 when the stock was at 180. It's been a 5-for-1 stock split. So let's use today's prices to illustrate. It was like $36 per share. I sold it 7 months later because I thought it was overvalued when it hit $140 per share. You know what the stock is at now? It's about $600 per share. It got as high as 900. You know how often I hear from people who love Tesla saying, are you sorry now? My response is not for a moment. I have to dance the dance I came to dance, not somebody else's. And this is what I believe about value. But that's what I mean by faith. With faith, you're essentially going to insulate yourself against a kind of peer pressure. You constantly, the market is it's like being in high school and there's this really cool kid that everybody wants to be around. The market's like that. You feel the urge to join the crowd. You feel left out. And no, you need to create your own mechanism for managing that. So I'm going to start by talking, I'm getting very close to the end. So I'm going to talk, as I said, this is more critical than any numbers I can talk about. But I'm going to talk about what I think are the three biggest enemies of valuation. I often get called, many of my students, because I've been teaching for so long, are now high enough up the ranks that they head equity research departments or M&A groups. So I remember the head of the M&A group at a major investment bank, old student of mine, calls me and he says, you know what, could you come in and talk to my group about valuation? And I said, why? He said, I don't like the quality of valuations we're turning out. I said, they're beyond redemption. He said, why? They're smart people. We hired the very best from Harvard and Wharton. And I said, it's got nothing to do with their qualifications. It's nothing to do with their intelligence. Your valuations are doomed for a very simple reason. It's got nothing to do with mechanics. It's got everything to do with something outside. And let me explain what these something outside can be that can bring your valuations down. The first and biggest enemy of valuation is bias. You know what I mean by bias? When you sit down to value a company, you never sit down with a blank slate, right? Because you walk in. Imagine if I gave you Reliance to value. Who forget about, nobody in India can start with a blank slate, right? You either like Reliance or you hate it, or there's nobody says, I've never heard of Reliance. Oh, this is an interesting company. You have biases. And guess what? Those biases are going to find their way into your valuation. There's nothing you can do to insulate yourself against it. And if there's too much bias in a process, valuations become pointless. You see why I told this M&A banking head why there's no point my coming in and talking about valuation to this groupers? I know some of you have plans to be M&A bankers. You might even be M&A bankers, but be an M&A banker for the next couple of minutes. I am an acquiring company and I come to you with a potential target. So look, we're planning to take over the target company. Should we do the deal? So you're my banker. What are the two possible answers you can give me? Yes, do the deal. No, don't do the deal. Let's play it through. If you say, no, don't do the deal, it looks too expensive, then what do you get as bankers? The undying gratitude of my shareholders, but try paying bonuses with that. Or you can say, yes, the deal makes sense, in which case you make 20 million. Do you think there might be a wee bit of bias in this process? Asking a banker whether a deal makes sense is like asking a plastic surgeon whether there's something wrong with your face. Think about it for a moment. What's a plastic surgeon going to say? You're already perfect? Then he has no business to do this. Your nose looks a little too long, your cheeks look a little too full. And it's not the banker's fault. It's self-interest that drives it. I personally think that we should stop doing valuation in M&A. You know what the value of a target company is? Whatever you've chosen to pay for it, plus $10. Why do we go through the charade of actually churning out a valuation that ultimately arrives at that number? First biggest enemy is bias. Nothing you can do about it, but at least you can be honest with yourself. Every time I value a company, one of the things I do before I value the company is I put my biases down. Everything I've learned so far about the company, say, you know what? I think this company is going to be undervalued, overvalued. You're saying that's prejudging? It is what it is. It is what I'm approaching the valuation with. And in statistics, there's actually a branch of statistics where you're required to do this. It's called Bayesian statistics. You know what you're required to do in Bayesian statistics? You're required to state your priors. Before you run a study, you're supposed to specify what you think you will find in the study. And when it first came out, people said, that's not right. You shouldn't be doing it. And Bay said, that's exactly what we should be doing. You know why I don't trust research for the most part? Is this notion that researchers are unbiased is so completely, I know from personal experience that there's no such thing as an unbiased researcher. In finance, in the sciences, you have a prior, at least be honest enough to tell me. So if you're a scientist looking at COVID and you think that wearing masks will not help you, state that up front. Say, now I'm going to do a study. And then if you show me that in the study wearing masks doesn't help, I'm going to say, you know what, I'm going to discount the study a little bit because you walked in with priors. Second, uncertainty. None of us likes uncertainty. Why? It scares us. As human beings, we want to make uncertainty go away. We deny it, we push it away, we outsource it. We ask, now think of how many times you feel uncertain. What do? You ask somebody else, your managing director, a consultant, as if they know what's going to happen. But this way you can blame somebody else if something goes wrong. And let's face it, when you value companies, you face uncertainty. When you face uncertainty, you get scared. When you get scared, you stop valuing companies. And what do instead? You price them. You know what? Venture capitalists are incapable of valuing companies, but that's okay. They price companies. So don't ask a VC for a discounted cash flow model. They'll have no idea how to do it or what to do with it because that's not how they think about numbers. But their defense is there's too much uncertainty. You can't value a company. So you've got bias, you've got uncertainty. And here's the third enemy of valuation. And this is something which has become a lot worse today than 40 years ago. When I did my first valuation, I'll give away how old I am. I did it on a ledger sheet. For most of you have no idea what a ledger sheet even looks like. A ledger sheet is just a blank sheet of paper with lines already pre-drawn, nothing on the paper, a calculator, and an annual report. Because that's all I could have. I mean, getting the annual report, I actually had to write to the company and they mail me the annual report back. It's the early 1980s. Today, when you sit down to value a company, think of how much more data you have. Think of how much more powerful your tools are. That's good, right? But here's the downside. It's become far too easy to build complex models. Now, and with these complex models, there's this notion of false precision, which is you think by adding more line items, you're making your valuation more precise. Well, I have a secret for you. You're actually making your valuation less precise. Less is more. I remember last summer, my youngest son, he's a junior, he was a junior at Yale, and he had a summer job at a hedge fund. Middle of the summer, he called me and said, Dad, I've been asked to do a discounted, he actually didn't say he had to do a valuation. He said, I've been asked to do a valuation, but as part of my valuation, I have to do a 3-statement forecast. You know, banks love to do, you know, the 3-statement forecast. You forecast the income statement, the balance sheet, the statement of cash flows. And he said, and he never asked me for advice. And he says, your valuation, how do you do that? And I had to make a confession. I said, in 40 years of value companies, I've never once in my life valued 3 financial statements. And he said, why don't you need items from them? I said, I need 6 items. Why would I be forecasting 500 items when I need those 6? What do I gain with those other 495? Other than the fact that I'm distracted, I can't spend the time on the things I need to focus on. I have never valued a company with more than 10 to 12 line items. And the younger companies and the more uncertainty I face, the fewer the line items become. So if you look at my valuation of Airbnb or Amazon in 2000, you'd see 5 line items. Because I want to focus on the things that matter. Bias, uncertainty, and complexity. I call this the Bermuda Triangle of valuation. For those of you familiar with the Bermuda Triangle, there's this legend of this triangle in the Atlantic where ships and planes disappear into thin air. Bermuda Triangle of valuation is where good sense disappears. When uncertainty, complexity, and bias here enter the game. You can know everything. You could have taken every valuation class, watched every valuation video there is, but your valuation is going to get sucked in to the middle. And that's something you have to be ready for, because you don't control this process, right? You get hired as an equity research analyst. There's already bias in this game. You can't make it go away, because you got to keep the companies that you follow happy, right? There's a reason why buy recommendations outnumber sell recommendations 8-1 all over the world. Because you put a sell recommendation on a company that you follow, God help you the next time you try to get a meeting with the company. So I'm going to, given that I have very little time, I'm going to kind of talk a little bit about, I'm going to skip the valuing of the market, which is, I did the S&P 5, you can watch that later, but I want to talk a little bit about valuing companies and spend about 10 minutes. Remember I talked about uncertainty, that when you value a company, uncertainty is your enemy. The amount of uncertainty you face is not the same on every company you value. I mean, if I gave you Hindustan Lever to value, you will have a much easier time than if I gave you Ola to value. And here's why. When you value a company very early in its life cycle, you have very little to go on, right? You have no financials, no business model. You often don't know what the market will look like. You face a lot of uncertainty about the company, about its future. As the company becomes more mature, valuations become more based in historical data. You have a crutch. Even if that crutch is not a very good crutch, you can say, this is why I'm assuming this, because over the last 10 years, the average margin for this company is 18%. Do you see where I'm going with this? You tell me where your company is. In fact, I'm very fond of this corporate life cycle structure. I use it in my corporate finance class, my valuation class, my investment philosophies class, to kind of illustrate why not every company looks the same to you, and why you might have to worry about different things in different companies. A very young, startup is like a baby. A very young company is like a toddler. Falls, gets up, sometimes falls and doesn't get up. Then you become a teenage company, then peak of your life, then you get middle-aged, and then you get old. There are a lot of old Indian companies, right? Their glory days are well behind them. You asked me to value Godrej. I'm not putting some high growth potential here. This is a company that's had a glorious past, but it's well past middle-aged. The challenges you face become different, but the reality is the amount of uncertainty you face is much greater with young companies and with more mature companies. You know why every valuation book is designed to value money-making companies with long histories? Because all the books were written, at least the core of them, the models were developed in the 1950s, the 60s, the 70s, the 80s, often in the US. And there, the core market was composed of mature companies. So you could take past earnings, project it out, use this neat modeling, and it worked. What the dot-com boom brought is it brought younger companies into this space. But analysts are still stuck in the 1980s when they try to force these companies through, and they said nothing's working. So that's part of the reason I want to simplify things, because if you simplify things, you essentially have the levers under your control. For those of you who've seen my valuations of companies, they're driven by 5 drivers. 5, that's it, 5 drivers. So let me list out the drivers. And you can take any of your favorite companies and put them through these drivers. The first driver is for growth. How much growth is in that company? What is that a function of? The size of the company, the size of the market, what's happening in the market. So the revenue growth rate captures the growth part of your story. You're saying, why are you focusing on revenues? Why not earnings? Because you can be a mature company with fast growing earnings. Why? Because you're cutting costs and doing something. But that's not a growth story. It's a different story. So growth stories always are about revenues. But revenues by themselves don't deliver value. Revenues have to become earnings. So even if you're losing money now, the second part of your story is about the profitability part of your business. And that I capture with your operating margins. Why operating margins? Because I want to look at how much money you make before you go out and borrow money and do all that other stuff. And if you're in a if you're an online advertising company, you know what those margins look like? close to 50%. That's what Facebook earns and Alibaba earns. But if you're a manufacturing company, your margins are going to be closer to 10% if you're a really good company. So you can't compare margins across companies and this is a good company. This is just different business models. So the operating margin captures the profitability part of your business. But there's a third lever you always have to think about, because to grow, you have to reinvest. That's almost a given. The question is how much? And I capture that with a sales to capital ratio. Basically, I look at how much revenues you get for every dollar of capital invested. And the more efficiently you can deliver growth, the higher that number is going to be. Revenue growth, margin, sales to capital. You give me those three numbers, I can move the word. I don't care what company, young or old, I can value just about any company. And I can take any business model, any story, and put it into those levers. And when I think about risk, I think about the two ways you can raise money. You can raise it from equity, you can raise it from debt. The cost of raising money from debt is a little more straightforward. It's because it's based on credit risk, right? Risk-free rate plus a spread based on how much credit risk there is in your company. You could use a rating if you feel you can get it for the company. You can, I mean, remember, even before companies had ratings, banks were lending the money, charging spreads. So the fact that your company is not rated by Chrysler or S&P or Moody, who cares? You can still attach a default spread. That's your cost of debt. The cost of equity is a little more intricate in terms of the dance you have to do. The cost of equity is what your equity investors demand for investing in your company. You're saying, what's that going to depend on? It's going to start with the risk-free rate as a base. It'll depend on the price of risk in the equity market. What are investors charging collectively to invest in equities? That's the equity risk premium. And then there's a measure of relative risk for your company. Is it riskier or safer? That I don't think of betas as carrying the burden of modern portfolio theory. I don't think of betas as coming from regressions. Betas to me are measures of relative risk, right? Beta 1 is an average risk company. So basically I have a cost of equity and a cost of debt. They feed into a cost of capital depending on how much of each you own. So that's where my risk comes in, is it comes in through the discount rate. And that's where we usually stop in valuation, but I think we make a mistake by doing that. When you do a discounted cash flow valuation, you're assuming your company will make it as a going concern. Do you know what I mean by a going concern? Whatever troubles it has, it makes it through them to go to nirvana. You know what nirvana is in your DCF, right? What's your biggest single cash flow in your DCF? It's your terminal value. To get there, what do you have to do? You have to live through the next 5 or 10 years. But we do know that companies don't make it through, right? They fail, either because they're young companies that run out of cash or old companies have too much debt. Where in a DCF do you show it? You can't show it in the discount rate. Take my word on it. The discount rate was not designed for this kind of risk. So I bring that in through risk of failure. And when you fail, I ask, what will my equity be worth? Because if you fail, what do I have to do? I have to liquidate your assets, pay off the debt, and if there is any money left over, I'm going to get it as equity investors. It's going to be much smaller than what I get as equity in a going concern, but I've got to be open to that possibility. Last March, I valued Boeing at the peak of the COVID crisis. It's one of the largest companies in the US in terms of manufacturing companies. I did a DCF, but I attached a 20% chance of failure. You know why? Because in March of 2020, there was a very real chance that Boeing wouldn't make it. They had debt coming due. And in that 20%, where they didn't make it, my equity was worth a fraction of what it was worth. I still ended up with a value greater than the price. So markets were clearly also incorporating it. But that's it. That's the levers. And when you tell a story for a company, you're looking to play that story out in those levers. So when you think about valuing a company, that's where stories connect to the numbers. And in fact, now one of my more recent books is Narrative and Numbers. It's actually one of the most fun books for me to write, because it was about, hey, how do you take stories about companies and make them numbers? And what you would see in story after story, because I tell a story about Uber in 2013, about Ferrari in 2015, so essentially about mature companies. Yeah, with every company, I go through a 5-step process. I tell a story about the company based on what you know about the company. Make sure the story you've told is not a fairy tale, that it's possible, plausible, probable. Sounds like I'm playing on words, right? With each one, I'm upping the ante. Lots of things are possible. A subset of those are plausible, and even a smaller subset are probable. Then I look at those three levers and say, how do I play those out of the three levers? And once I do that, the valuation does itself. I don't have to sit there with an Excel spreadsheet. The spreadsheet is just mechanical. It takes my inputs and converts them. And then there's a step 5 that I'd strongly encourage you to take, but it's going to be more difficult for you than me. You know what tends to happen in the world we live in? We tend to get specialized. In whatever we do, we tend to hang out with other people who are specialized in the same things. In other words, we hang out with people who tend to think like we do. They went to the same schools, read the same books, have the same way of thinking. And we all agree with each other, no surprise. I'd strongly encourage you when you value a company to seek out people who don't think like you, who don't have your background, a very different perspective. They're not going to understand this beta stuff or equity risk. That's okay. You can still value companies, and listen to them and see if there's anything in what they're saying that you can use to make your story better. Every time I value a company on my blog, I try to be explicit about this process. In fact, the Excel spreadsheet I've built and put on my website comes with a worksheet where I take your numbers and say, now fill in the rest in terms of a story. It encourages you to think about the story behind that growth rate you're giving me. So if you're giving me a 10% growth rate, I'm always going to ask and say, hey, what's driving that 10%? And you say that because that's what they've grown over the last 10 years. You can see how empty that story is. You're telling a story of just everything, it's mean reversion. Everything is just converting back to what it convert. That's no way to value companies in a world where everything keeps changing under our feet. And guess what? This is a lot more fun than sitting there with an Excel spreadsheet and playing with the growth rates, because that's what it becomes. Is if you don't have a story, why 12? Why not 15? Why 15? Why not 18? You can keep playing with the numbers till you get whatever number you wanted to get in the first place. So if we get a chance, we look through the slides. I've taken this process and applied it in Airbnb. That's how I came up with the 40 billion. So if you ask me, where am I getting the 155 billion in gross bookings in 10 years? It's because I think Airbnb is going to change the hospitality business, maybe double it, and be a dominant player. Why is it going to be a dominant player? Because this is a business with networking benefits, which means as you get bigger, it gets easier to get bigger, because if you want to put your house for rent, you're going to go to the place where most people already hang out, not some startup. So it's like Uber and Ola, that says the first mover often starts with a decisive advantage. Why will its margins be high? Because it's an intermediary. It doesn't own the houses, so there's no fixed costs. It doesn't maintain them. Intermediaries have high margins. Booking.com, which is the company closest to Airbnb, has 35% margins. So when you look at the spreadsheet, it looks like a spreadsheet, but every number is a story behind it. And every discounted cash flow valuation I look at, what I try to back out is, what's the story that's being told here? And then I play that story back to the person who sent me the DCF and say, do you believe the story? And you'd be amazed how often people say, no, I don't like that story, but that's the story your DCF is telling me. Every discounted cash flow valuation sings a song. If you're willing to listen, you can hear the song, play it back and say, hey, you know what? Do I like that song? Is that a song I can live with? It forces you to get from numbers to the underlying business. So I'm going to stop there because I want to give you guys at least 25 minutes to kind of ask questions. So I'll pause there. I know we didn't get through the slides, but guess what? The slides are out there. I've talked enough about these topics that if you want to delve in, you find multiple places to delve in on. So since I want to give you a chance to ask questions, I'm going to turn off the slides and let you essentially ask questions.
So Sumit Ray from XLRI has a question.
Okay.
Sumit, go ahead. Sumit, please unmute yourself and go ahead.
I don't.
Yeah.
Tushar?
Yeah.
Sorry.
Am I audible now?
Yeah.
Yeah, hello, sir. Thank you for your valuable insight. I wanted to ask you something about something which is more relevant in the Indian stock market. Since you talked about efficient market, I wanted to get your opinion on circuit filter, which are applicable in the Indian stocks. Like, do you think like putting a 20%, 10%, or 5% circuit filter on individual stock hamper their movement in the long run? I see like GameStop. See,
There are two ways you can play the market. You can be an investor or you can be a trader, right? Investors invest based on value, traders based on price. If you're a trader, this is a huge issue. Why? Because every time you have a circuit breaker, you're essentially stopping momentum. And momentum is how you make or lose money on trading. So as a trader, this is a huge issue. So when traders have these conniptions about circuit breakers and market frictions and not being able to sell short, I understand. I mean, I think that, I think for them, this is the center of the universe. As an investor, I frankly couldn't care less. I prefer more liquidity to less liquidity simply because I make money on corrections, and I'd rather have a process where corrections, when they happen quickly. So, but that's the only place it plays out. Here's one thing I've learned. If I worry about things that I don't affect me, I'll spend the rest of my life developing ulcers. So here are the things I don't worry about. I don't worry about market frictions because as an investor, I play for the long term. I don't worry about what other people are paying for stuff. Don't sit there and say, oh, that's crazy. Why they're paying that much? What business is it of mine? If they want to pay, so you'd be amazed how often people say, well, how do you explain the $600 people are paying for Tesla? I said, look, I don't have to. I didn't pay it. I've never felt the urge to explain what other people pay or do. So am I concerned? I am in general concerned with any kind of regulatory attempt to save people from themselves. You know what I mean by save people from themselves? A lot of this is motivated by what? That traders left them to themselves are going to do stupid things, are going to hurt themselves. So we're going to stop that from happening by adding circuit breakers or by, and you know what? A fool and his money will be parted no matter what. And I don't think it should be our business to step in and this notion of retail investors being these poor, defenseless souls. Come on. If you're a retail investor and you try to jump on a bandwagon, you're doing it for the same reasons. What is it motivated by? Greed. And when you're greedy, what happens? You get stupid. This is not just retail. Any investor who's greedy is going to do stupid things. And then, of course, he wants to be protected from his own stupidity, blame other people. So this notion, and I do an entire session on this delusion of smart money. You've heard the word smart money, right? With smart money, professional money managers. There's no such thing. There is no smart and smart money. All money is stupid when it gets greedy. So as a general rule, I think that restrictions trying to protect investors from themselves never work because they'll find some other way to do something stupid with the money because greed drives you there. Now, I'll close with something completely unrelated. I get so many emails from people saying, I'm approaching investing, I want to get rich. Where should I start? And my response is don't call it investing for a second. Don't get in the market because you want to get rich. You invest to preserve and grow your wealth. So if you want to get rich, go be a doctor, go be an engineer, earn a good salary, put it into that portfolio. Use investing as a way of growing what you invested. But they've seen stories of other people who got rich by investing in a stock and they want to do the same thing. They're going to do really stupid. You can read the script on this, right? It's like a guy going into a casino saying, I'm going to get rich tonight. I predict when he comes out the next morning at 5 o'clock, because he's going to gamble all night, that he's not going to be rich. Maybe that one guy makes it out rich, and he, of course, gets a lot of publicity. But I think greed is at the source of many of the issues. And of course, regulators try to protect you from your own greed, but it never works. Himanshu? I'm going to go just with the hands as they go through. So just put up your hand and I'll call you. Go ahead, Himanshu.
Yeah, thank you, sir, for the session, first of all. And the second one is, while evaluating the companies, the discount rate plays a key role. And you talked about the
back up. The discount rate doesn't play a key role. You think it does. It's often not even on their top 10 list of inputs driving it. You know why we make it play a central role? Because we feel more in control when we estimate discount rates than when we do growth and margins and cash flows, right? Because then you can bring in all your tools, that neat tools you developed going to school, the beta, the risk premium. It allows you to kind of show the world how much you know about valuation. But the reality is discount rates are not that important. You know what the median cost of capital in US dollar terms for a global company was last year? 5.8%. If you want to convert to rupee terms, add about 4%. So you think in terms of the median Indian company, it probably has a cost of capital of about 10%, maybe 11%. You know what the 10th percentile is? It's about 8%. You know what the 90th percentile is? It's about 15%. So all of this is to do this dance between 8 and 15. When that time would be so much better spent projecting growth and margins and business models. You know what I tell people? Look, if you're in a hurry, take the median cost of capital. If you're valuing an Indian company in rupees, take 10 to 11% as your cost of capital. Finish your valuation, growth and cash flows. And if you have time, come back and revisit that and make that 11% 10.83%. It'll make you feel a lot better, but it's making no difference to your valuation. So I didn't want to, but the reason I interrupted is, if you start with the premise that the discount rate is a key input, guess what you're going to end up doing? You're going to spend too much time on the discount rate. You're finessing to the second decimal point. Where do I get the risk premium? How do I make sure it's right? And the response is, let it go. It's not that important. It's an input. It's not the key input. So I'm sorry to undercut the rest of your question. What was the rest of your question?
Yeah, so I was asking that is it the time to include the pandemic risk or the health infrastructure of the countries as well?
Say, discount rates were not designed. Don't make the discount rate the receptacle for all your hopes and fears, which is what we tend to do, right? I'm feeling scared, I'll push up the discount rate. Feeling a little uncertain, I'll push up. My ulcer is acting up, I'll push up the discount rate. The discount rate is designed to capture exposure to macroeconomic risk. Is COVID, it's not COVID, but the potential for other pandemics, should we be building it into it? Yeah, but that's a discrete risk, right? Let's say every 10 years, we're going to have a shutdown. It's not a discount rate effect. It's an expected cash flow effect. Every time I value a hotel from now on, what am I going to do? I'm going to build 9 good years and 1 bad year, which means that when I'm doing a growth rate, instead of using an 8% growth rate for the next 10 years, I might end up using a 6 point, because I don't know which year it's going to hit, right? Unless you have this crystal ball. So it's a cash flow effect, not a discount rate effect. And maybe that's what you're seeing in markets. The market's saying it's not a discount rate effect. Equity risk premiums are back to where they were before the pandemic.
Got it. Thank you.
Niharika?
Hello, sir. Good evening. And thank you so much for taking your time out for this enriching experience. Sir, you mentioned something about the users or the subscribers or consumers for a company. And my question is more based on your experience of valuation. And it's that how do you and where do you factor the users into the the 6 pillars that you told us about the valuation? So where do you factor them and how do you factor them? So that was my question.
Why are users valuable to a company? By themselves, users are users, right? We don't live in a world of slave labor where you can say, you know what, I'll send 3 users over to you because you're an equity investor in the company. What do users ultimately have to become? They've got to deliver revenues. They've got to be able to convert. So users, subscribers, so when you say you have a lot of users, you got to think about how does a company make money of these users? And there are 3 ways you make money of a number of users. The first is with a subscription model, right? Where users pay subscription. So with Netflix, the value of subscriber is very simple. It comes from subscription revenues over the lifetime of a subscriber. It's a little more complicated if you're a Facebook. To be a Facebook user, they charge you nothing. There's no subscription. So how does Facebook make money of the fact that lots of users? What does it do? What does it do to make money off the fact that there's 2.5 billion users?
They run ads?
It's an advertising company. They use the users, so you can charge subscriptions, you can run ads. What about Uber? It doesn't have a subscription model. It doesn't have an advertising model. So how does Uber make money? It makes it through transactions. Right? Every time you use Uber, you're paying Uber 20% of the fare. There are only three ways to make money off consumers. You can make money on a subscription model. You can make money on an advertising model. You can make money from transactions. So every time I see a founder saying, I have this great app and I have 100,000 users, my first question is, how do you plan to make money of these users? And the founder says, I haven't thought about that yet. I say, okay, come back to me once you've thought about it, because you don't have a business right now. You just have a gathering place. So don't fall for the game where a lot of startups say, look, I have lots of users. We'll figure out what to do with it later. Just pay me now for the fact that I have lots of users. That's absurd. So when you see users, the question always is, how do those users become ultimately those cash flows? And it shows up either through the growth number, maybe by having a lot of users, you're growing faster, right? You're charging them more subscription fees or bringing more subscribers. But the margins are embedded in there, right? Because you tell me how much you charge for your subscription, then I can back out from that what your business model is. One of the problems that Netflix has right now is its growth is coming almost entirely from India. Right? The number of subscribers in the US, you've hit a, and there's a problem with that growth, which is a typical US Netflix subscriber pays, right now I'm paying $17.99 for a subscription where 4 screens can be on. You can get it as low as 14, but that's the lowest monthly. A typical Indian subscriber to Netflix, don't they have that phone-only mode where you can do it for $3 a month? You know what surprises me? That not a single analyst, in the last earnings call that Netflix had, they boasted about the fact that they added like 9 million subscribers. If you are valuing the company, that's good growth, right? But what's the question you need to ask about the profitability? Where are those subscribers coming from? Because they're coming from India, that's a much more lower margin subscriber than a subscriber in Europe. That's what the levers do, is they give you the framework for saying growth is nice, but growth by itself is not enough. How does it convert into profits? So the levers still are what drives it. And how do you increase the number of subscribers if you're Netflix? You got to go acquire them. The cost of acquiring customers becomes a reinvestment. Are you efficiently so if it costs you $1,000 to add a subscriber, I don't care how good that subscriber is, I'm losing value. It's still about growth, profitability, and reinvestment. It's framed differently for different companies. For a manufacturing company, reinvestment might be plant and equipment. For a pharmaceutical company, it could be R&D. But for a user-based company, it could be customer acquisition costs. Aishwarya?
Hi. First off, I'd like to disagree with you that you're not good with words. I think it's been a very engaging session. I personally loved the story around valuation, which I've, I think, heard for the first time. I'm going to ask a question, which I think part of which you covered with Himanshu, but I'm going to go ahead and ask anyway. In terms of valuing companies right now who would have undergone COVID and gotten overvalued in the short term, how would you account for that? And I'm going back to the example of Zoom for this, because I think their value kind of shot up in the last year itself. I think increased their share price for around 400% increase. So just wanted to get your thoughts on how would you go about looking at it, or would it just become that one bad year that you...
well, price versus value. You're saying it became overpriced. It didn't become overvalued. It became overpriced.
I think
so you're saying the price has run ahead of the value. Right?
I think valuation as well went up to 100 billion. It was 20 billion.
Then there's nothing to discuss. Then it's okay. Right? Then if the value went up and the price went up, then it's fine.
But
it's the fact that you think the price went up. Do I think it's overvalued? I think the story has gotten, I think the price has gotten ahead of the story, because embedded in the story is the assumption that a lot of the customers that Zoom got are not just long-term, but they're also going to deliver a lot more profits than they do now. Right? And that part of the story might be a little overwrought. We won't know. right?
Okay.
Until COVID passes, how much of this, I mean, how many businesses might go back to Zoom as their meeting device? And in fact, there are many companies that claim that Zoom meetings are more efficient than the meetings they used to have in physical offices where people were wandering off, checking their smartphones, doing all kinds of other stuff. This way, at least you're not bringing people in and feeding them donuts or whatever you were feeding and not really getting much done. So we'll find out. I would not buy Zoom at the existing price, but I think that there are stories you could tell. It's a plausible, there's a plausible story you can use to justify the price.
Got it. Thank you so much, sir.
Welcome. Tushar?
Hi, sir. First of all, thank you so much for conducting this session. It's been absolutely fabulous, to say the least. So I had a question with respect to valuation of aesthetic items. Basically, how do you go about in the valuation of aesthetic items, say like artwork?
You can't value artwork. You can price it.
Or
right?
any other.
This is what I meant. No, if it's a non-cash flow generating item, you cannot value it. You can only price it. You can't price artwork. You cannot price a currency. You cannot value artwork. You cannot value a currency. You can price it. That's what an exchange rate is. You know what the next steps. You cannot value Bitcoin. You can only price it. Collectibles and currencies can only be priced. And that's why it's when something can only be priced, it's entirely driven by demand and supply. So it's saying, how do we then, make money on artwork? You got to get ahead of that momentum game. So if you buy a Hussein now, you're already paying top dollar. But if you bought a Hussein 40 years ago, I mean, that's appreciated a lot. You got on the right side of momentum. So when you look at collectibles, artworks, currencies, you're looking at things without cash flows. You're looking at things that are driven entirely by the pricing process. And already a lot of frustration gets removed. I've seen people write entire papers about the value of Bitcoin. And my response is, you don't even know what the word value means when you say the value of Bitcoin is. Bitcoin can be priced. We can talk about whether 50,000 or 60,000 is a fair price, but it's got nothing to do with value. Avinit? Still muted.
What name did you take?
I'm sorry, who's it? Oh, who's asking the question?
This is Ayush. I'm the one unmuting people.
Okay. Okay.
Whose name did you take?
Avinit, is that right?
Yeah,
okay.
I got it.
Avneet Singh.
There.
Yeah.
Okay.
I'll straight away get on to the question. So my question is specific to the recent surge in bond yields and the impact it is having, the concerns that it is raging in the equity markets. How relevant do you think it is? What is your point of view on it? And where do you think the Indian equities stand with these sudden surge in the yields?
Are you talking about the UST bond yield? Is it?
Yes, which has surged to 1.7%.
First, it kind of shows you the emptiness of believing the Fed somehow controls rates. This notion that the Fed sets rates is one of the most dangerous delusions in the face of the earth. Why are rates going up? What's driving them? They're up from 0.93% at the start of the year to almost 1.7% today. What's driving them up? You're muted still. No. You're muted, Avinit. I'm sorry, I can't hear.
No,
now.
I think, yeah. So it's primarily driven by the surge, the pumping of the stimulus and the inflation fears that has gotten into people.
But also what by the stimulus by itself, what are people expecting it to do? That push up the growth in the economy. So it's basically been driven by growth expectations getting a little rosier and perhaps worries about inflation. Right? So rates almost never go up in a vacuum. To those same forces, remember in the numerator, you've got cash flows and earnings. The same forces play out in our earnings and cash flows. So the forces that are pushing up rates, could they also affect the earnings that people are expecting on stocks?
That seems to be a fair assumption because.
So now you can see the net effect can be positive, zero, or negative, right? Rates, I mean, people often talk about rates changing as if that's the only thing that changes in evaluation. But when rates change, the question I always ask is, why are they changing? What else is changing? Because until you answer those questions, rates can go up and value can go up. Rates can go up and value can go down. Rates can go up and value can do nothing. Right now, the market can't make up its mind. At least on average, it seems to think that the earnings bump is going to compensate for the higher rates. But that's on any given day, right? So if you get bad news about growth, then you're very quickly going to see an adjustment. That's why I think you're going to see back and forth until you get that contradiction to be resolved. I think that that's, so when you look at rates going up, I think that that is just a piece of the puzzle, and you got to look at why rates are going up. And to be honest, if it's inflation that's driving rates up, that's deadly for stocks. That's not good. If it's real growth that's driving rates up, then I think we're perfectly okay. Then I think we can survive. And that's why the inflation numbers are going to have an outsized impact this year. And you're going to see it play out. If inflation comes in higher than expected, you're going to see very sharp corrections.
Right.
Because that I think you get the worst of both worlds, higher rates, but no real growth.
Thank you, sir.
Suyash?
Hello, sir. Am I audible?
Yep.
Yeah. Hello, sir. Thank you for this session. I just wanted to ask your opinion and wanted to know your perspective on the recent GameStop versus Wall Street fiasco that has happened. So you mentioned that social media has presently got an influence on the valuation. So something like
pricing. So
yeah,
let's be careful. The key, I'm fixated on this in my class. Whenever people say valuation, I correct them because pricing is driven by demand and supply, right? And how can a crowd affect pricing? You get a crowd on the same side of demand or supply, you can push up the price. That's basically, I call it the first crowd squeeze in history, because you get a bunch of people on the same side. So does that bother me? I think people make a huge deal out of it. They act like the entire world. This is not the first time this has happened. What social media has given is a platform where crowds can gather together in much larger numbers than before. And what will that mean? There will be these targeted stocks, or the crowd decides it go. And if the stock is small enough, and if they tried this on Apple, I don't care how big the crowd is, you couldn't make a dent. The reason it worked on GameStop, a small company with limited liquidity. They tried it on silver, it failed again. So don't overread what's happened with GameStop. It's happened, it's something that you have to be wary about with small companies. But again, you know who has to be wary? Not me. If I'm an investor, I'm an investor. I don't care that this game happens. In fact, it might give me more opportunities. But if you're a trader, this is something that has to get factored in. If you're a hedge fund that sells short on these companies, clearly this now becomes a consequence you got to build in and be a little more wary about being out there and making yourself a target.
Okay.
So I'm not.
And,
yeah, go ahead,
sorry.
Sash. Yeah.
And I mean, would this is like a one-time phenomenon, or do you think like this is
even if it's a multiple? I mean, this is who was hurt by this? Why are we making such a big deal? Who was hurt by this?
Probably egos of Wall Street people, but
they, I mean, but don't make Wall Street collect it. The biggest winner in this fiasco was a hedge fund, Silver Lake, that owned $600 million in convertible bonds at GameStop that converted the higher price. This notion that hedge funds lost and individual investors won is a nice story, but it's not the truth, right? Some individual investors won. A lot of individual investors who bought at 300 or 400 have lost money. Collectively, do I feel sorry for them? Not really. They played a game. They gambled. That's like a guy who enters a casino, loses money, and says, "Why do you let me do it?" And then blames everybody in the world for the conspiracy that cost him the money. And this is what I meant earlier about trying to protect people from their own sins. I mean, to me, this game played out. There were hedge funds that won, hedge funds that lost, individuals that won, individuals that lost. Why should we contort ourselves as the rest of the world trying to fix their problems? Because that will continue. They'll keep playing these games. Let them play their games. Let them make money, lose money. Just don't come whining to me when you've lost money whether you're an individual or a hedge fund, complaining about how fixed the game is. Right?
All right. Makes
So
sense.
that's my point, is don't make too much of it. This has not changed the world. It's been around a long time. Social media is this creative platform where you're going to see this happen, at least with small companies with low market caps.
Okay. All right. Thank you so much, sir.
Somnath?
Sir,
I'm sorry.
we've received a question from XLRI itself.
Yeah.
The question is, you have valued so many companies. Have you ever tried valuing a country? How would you account for human resources in your business valuation?
No, to value a company, you value company because it's a for-profit entity. There are investors who collect it. You can't value non-profit. You know why? There's no cash flows left over. It's all the cash flows are dispersed. The problem with the country is the end game for a country is not maximizing value, in which case, you'd collect taxes, you would never spend money on any infrastructure, you claim the cash flows, but who gets the difference then, right? So I think that you can't value countries, you can't value nonprofits. You can look at the collective value of all of the businesses in the country, right? Because that's value created. But I don't think you can value things where there's no residual cash flow that somebody's claiming.
Right, that makes sense.
And that's why you can't value university in the US, because universities in the US are nonprofits. Doesn't mean that they don't collect money and disperse them, but you can value some universities in India because they're for-profit.
Right.
The difference in business models that drives that choice. XLRI is not for-profit, right? It's a non-profit, or is it a for-profit?
Non-profit.
You're not giving away any secret. Yeah. So, but so that's what drives whether you can use valuation. Somnath?
Thank you, sir, for this wonderful session. When you said that you cannot value Bitcoin, you cannot value artwork, I would assume that you would also agree with the fact that you cannot value derivatives in the stock market. They can only be priced.
No, derivatives are not standalone assets, right? So derivatives are priced because they're defined by arbitrage relationships. You could value a derivative, but that value is constrained by the fact that derivatives derive the value from an underlying asset.
Yes.
Which means the underlying asset, if it's misvalued, you can try to make money in the derivative, but you can't make money in the derivative itself. Right?
Okay.
So you can price derivatives relative to the underlying asset. But if you ask me, is a call option on Microsoft, should I buy it? If I thought Microsoft was undervalued, I'm going to say go buy the call option, not because the call option is undervalued, but because the underlying asset is undervalued. So the reason we only price derivatives, it's the underlying asset that has the value. The derivative is a leech. It derives its entire cash flows from the underlying asset.
Then, sir, we have a plethora of traders who do trades on stocks as well as in the derivatives market. Is it just greed that keeps the traders going, in your opinion?
It's greed. Well, why is greed a bad thing? What is it?
Well, it's not a bad thing.
No, but in a sense, you invest in markets. Greed is part of the game, right? Warren Buffett is greedy. Peter Lynch was greedy. Why? Because they didn't settle for the risk-free rate. They wanted to not just earn the market, they wanted to earn the market plus. So yeah, you want to make money. So if I'd replace the word greed, they're doing it because they want to make money.
But so is
everybody else, right? So basically their way of trying to make money is they think they can call the direction of stocks or derivatives using momentum. That's what trading is driven by. And if you're good at detecting momentum, you're going to make a lot of money. And you know what? I have absolute respect for people who are traders who can call mood and momentum and get ahead of the game. It's a different game. It's not a game I'm good at. But I'm not going to point fingers and say that's a bad game. In fact, I would argue many people who claim to invest based on value would be better off just admitting that they're momentum traders, because that's what they do. They then create this after the fact justification for what they did. But that's basically what they're playing. They're playing the momentum game.
Right. Thank you so much, sir.
Okay. Akshay, I have about 5 more minutes because I have to kind of run for another commitment. Akshay, go ahead.
Yes, sir. Is my voice audible?
Yeah.
Yeah. Okay, sir. My question is a quick flip through the today's newspapers, or the perception that has built is that the professional standards in the banking and securities industries are eroding. Um, One of the greatest challenges in the banking and securities industries is that the restoration of its reputation for high professional conduct has to be maintained. So I just want to get your views on that.
Would anybody disagree with that statement? I mean, that sounds like this statement that it's that you should love your mother and you should praise God, and it's a kind of a meaningless statement. And
Yes.
guess what? What the heck does professional even mean? What is professional? What is, ethical? I can understand, right? You don't want to, but what does professional mean? What does a professional appraiser do? I mean, so I think that this word is thrown around because until you specify professional, it means almost nothing, right? And that's why when people have these standards, we'll be professional, objective. Come on, it's easy to write those words. Everybody agrees with those words. I'll tell you something. When everybody agrees with a statement, it's kind of a useless statement because you've written it so broadly that nobody has any idea. Everybody walks away saying, "Okay, I agree with that." So I would encourage whoever wrote that story or to be more specific about what they mean. What would a professional banker do? Would they not lend to family groups with bad assets and make? No, I think that'd be something I don't want bankers to do. So rather than just do your job. Do your job. That's basically what I think. And do your job without letting your interest override those of your clients. And I think that's what we need to ask everybody to do, but it's more difficult than it sounds. It's easy to say it, but much more difficult to pull it off. Girish?
Hello, Professor. It's great to be interacting with you. I have a query with respect to certain businesses which have an underlying asset that needs a heavy upfront investment, and there is also certain cash flows that you can expect to get from that particular business. If you can look at a real estate.
Let's call it a toll road. Okay.
Yeah. So I'll take the example of a hotel, for example, okay. Right? You have different investors trying to value the hotel basis the cash flows versus a certain set of investors trying to value it based on the underlying property, which can be like a replacement value.
No, back up. You have certain assets valuing the hotel as a business based on cash flows. You have certain other investors pricing the hotel based on its real estate.
Yeah.
So, you don't value it based on it,
Yeah,
go ahead.
So I want to get your views on the fact that why is there no common meeting ground between the two? Because I have seen in practice that there can be a huge.
Why would the two be? Why would the two have a? No, but why would the two have a common meeting ground? Is it possible to run a hotel business where the real estate is worth a lot more than the? Absolutely. And is it possible to run a hotel business? Because the business is, if the real estate and the hotel were worth the same, why the hell would you ever go through the effort of starting a hotel and going through that pain, right? The whole idea of starting a business is to do what? Take the underlying asset, which is the real estate, and make it more valuable by running it as a hotel. So I would expect the two to be different. And if the real estate becomes higher than the hotel, here's what can happen, right? I would buy the company, and you know what I'd do the day after I bought the company? I'd liquidate the company and sell the real estate. They're not two different approaches to arriving at the same number. They're two different approaches to doing different things with the asset, right? Because the person putting a real estate price is saying, what if I sell the real estate today? That's what that pricing is. And the person running the hotel business is asking a different question. What if I took that real estate, ran it as a business? The answer should be divergent. And the divergence is what drives whether you stay a hotel or whether you end up selling off the real estate.
And Professor, does the answer change if the owner of the asset and the owner of the business are the same or different?
No, because the owner gets a choice, right? So the owner of a hotel finds that the real estate that his hotel is sitting on is worth more than what he's getting as a hotel. What's a logical thing to do? Shut the business down, sell the real estate, do something else. But the problem is, you're emotionally attached. You started this hotel, your grandfather started this hotel 80 years ago, and you don't want to let go. So as an owner, you might end up deciding to run the hotel, but you're doing it because, not because it's the best possible use of this asset, but because you have an emotional connection to this business that makes up for the fact that you're earning less by running it as a hotel than selling off the real estate.
Got it. Thank you so
Now,
much.
I have to make this my last question. So Rashika, you've had your hand up for a while. So what's your question?
Thank you, sir. So my question is actually pertaining from the answer that you gave to Himanshu. And you mentioned that discount rate is not the most important factor in valuation. So as per you, what is the most important factor? And apart from the discount rate?
It depends on the business, right? So there can't be one driver. If you're looking at a young startup built around users, it might be the cost of acquiring users. The driver of value is what's going to be different. And part of what you learn in the craft is figuring out what that driver is for your company. Yeah, I'll give you a couple of examples. When I value Netflix, you know what my big driver of value is? I have no doubt that they can keep adding subscribers. I don't think that'll be a problem. I have no doubt that they can get their margins on these subscribers because the subscription fees are pretty sticky. Once you get connected to Netflix and you love a show, you're not going to cancel it. You know what I worry about for them is how they get their subscribers. How does Netflix add subscribers? What does it do? It spends money on expensive shows. Right now it's Bridgerton, and I don't know what the shows are in India, but they spend their money on a big budget show. Content costs. And for Netflix, that to me has always been the weakest part of their story, is the amount of money they spend on content. They're the biggest spenders on content in the world, much more than Disney or any other. They spend $17 billion in content. The troubling thing is the content costs keep growing at a rate that is equal to or greater than the growth in subscribers. You know why that's a problem, right? You can keep adding subscribers, but the content costs keep going up. You're never going to make money. And the problem is they've created a business model where that content cost is designed to keep going up. They've trained us all to expect a dozen new shows every time we turn on Netflix. So when I look at Netflix, the number I constantly keep my eye on is that content cost. Are they doing something to bring that down, to keep it under control? So with every company, the driver is, with Uber, for instance, my big question is how they deal with the drivers, because as you can see around the world, they're being forced to deal with drivers as employees. It happened in the UK just recently. That's going to make a huge difference in their model. So part of doing valuation is taking your company and saying, in my company, what is that driver? And once you've identified it, make that the focus of your valuation. Think about, so when you think about collecting information, it's easy to get overwhelmed in today's day and age. There's so much information out there. So when you go look for information in a company, look for all information, you'll drown in it. But if you're focused, then what you do is you look for information on the variables that you worry about the most. You don't get distracted. Pramod, you got your finger up. So last question, go ahead.
Yeah, so I'll get into directly to the question. It's regarding Netflix itself. So you said that $3 is not a big amount to consider while taking Netflix valuation. That is the subscription amount in India.
No, I didn't say it was enough. I said the value of a subscriber.
Yes.
So when you think about value per subscriber, value per Indian subscriber is far lower than the value added. So if you told me that you're getting 3 million subscribers, it makes a big difference to me whether the 3 million are in India or in the US.
Exactly.
Now, I think where you're going is, what if I could get 300 million subscribers?
No. My question is, the same $3 has a higher value in India because it could buy a full meal for 2 days, let's say. But the same $3 doesn't buy a meal in US for 2 days.
But
so
Netflix is not in the business of buying meals, right?
Yes,
so you're talking about of consumption power, right? So that's perfectly okay. So I'm not saying that Netflix needs to charge $15 in India. I'm saying when I value Netflix as a company, I've got to look at what they can charge. And the fact is they cannot charge more than $3 in India. I understand that.
Exactly.
But it also means when I value Netflix, the value of those subscribers has to be given a lower overall value. than the value of its equivalent subscriber in the US.
Okay. So if Netflix was in India, let's assume, so will
It is
that
in
treat,
India.
I
Oh,
mean
you mean
to
as
say,
a publicly
yeah,
traded,
as a public, yes. So if it is in
and
India,
all
then
they had were Indian subscribers. Okay, let me take Netflix, put it in India, and give it the same subscription base it has now. I will value the same way. You see what I'm saying? If they had 100, so if you can start an Indian subscription service, a Bollywood service, and you sign up 50 million subscribers in India, in the US, who are willing to pay $20 a month for the service, you know what? I'm going to give you a high value. It's not whether they're in the US or India that's driving it. It's what you're making on that marginal subscriber that drives the value.
got it, sir. Thank you. Absolutely clear.
Okay, folks, I have to wrap up. I have another meeting in about 10 or 15 minutes, and I need to get ready for that. So,
so I think I can speak on behalf of the entire audience and then say that this was truly a scintillating session. You pointed out that there are numbers people and stories people. And then what you proceeded to do was create a story around the numbers that shattered a few illusions, broke a few misconceptions, and above all was beautifully candid. I have no doubts whatsoever that every single person here derived value from this session. As the president of the Kautilya Consult Club of XLRI PGDM GM, so I would like to thank you. And now I'd like to invite Shilpi Sinha, the vice president of the Kautilya Consult Club, to formally deliver the vote of thanks.
Ayush. Thank you, Professor Damodaran. On behalf of Kautilya, the Consult Club of the General Management Branch of XLRI, I would like to thank Professor Damodaran for such an engaging session. We've read your books, and we've all those formulas and models and everything, reading all that, and then now we discover that the balance sheet tells a story more than anything else. So it is a completely perspective changing session for us. Thank you so much, and have a great day, sir.
Thank you. Take care, folks. Have a good day. Good night, at least. It's late in the night.
Thank you so much, sir.
So take care. Bye-bye.
Thank you so much.